Today, we're going to be talking about active versus passive investing. Which one's for you? My name is Emir and welcome to the Millennial Finance. Whoosh! In older articles and videos, we've always been an advocate for index fund investing. Index funds are considered passive investments. This is because it requires little to no input from the investor other than making the purchase. If you're a new investor, we definitely recommend that you try out with passive investing first. If you want to watch our video on index fund investing, click the link above. For those of you who are looking for an adventure though, maybe we can explore active investing. Now, we don't encourage active investing for the large majority of people due to its risks, but if you have a keen interest in learning, it can pay off handsomely. So, which one's for you? When comparing the two, there are a few key considerations that we need to take into account. Let's start. First of all, diversification. We won't get too much into this because we've talked about it in previous videos. Putting $1,000 in 500 different companies instead of just the one means you have more exposure to the different industries, markets, as well as company size. For example, the Dow Jones Index is a collection of 30 blue chip companies, which includes the likes of Apple, Boeing, Johnson & Johnson, Walt Disney, and McDonald's. Straight away, we can see that these 5 stocks have nothing to do with each other. On the one hand, Boeing builds airplanes for commercial and defense purposes, while on the other, Johnson & Johnson develops pharmaceutical and skincare products. Apple is worth a whopping $1 trillion, while Boeing is only worth $60 billion. Only. With the introduction of robo-advisors, things get even much easier for passive investing. You'll not only get diversification in your stocks, but you also get diversification in your indexes. For example, there's healthcare, technology, and consumer discretionary products. This then leads us to our second consideration, being risk-reward levels. Through large diversification, you minimize your exposure to risk. How this works is if you invest in the S&P 500, the bankruptcy of one company will be offset by the other 499, which minimizes your losses. To show this, let's go back to our Dow Jones Industrial Index example. From the 18th of February to the 17th of March 2020, the Dow Jones Index declined by 27%. Bruh. Boeing, one of the stocks in this index, lost 63% of their value during the same time period after airlines started putting their plane orders on hold. The 36% differential in returns is attributed by the fact that while Boeing lost 63%, the other 29 stocks in the Dow Jones Industrial Index helped balance this out to 27%. Meanwhile, Procter & Gamble, another company in the Dow Jones Index, only lost 6%, which outperformed the Dow Jones Index by 4 times. This goes to show that by choosing individual stocks instead of index funds, you have the potential to way outperform the market or way underperform it. If you were an investor in Boeing, you would have been the biggest loser as you lost 63% of your portfolio in the space of just 1 month. On the other hand, if you bought Procter & Gamble, you would have been happy with yourself because you outperformed the market by 4 times. To summarize this whole thing, active investing means that you'll be exposed to more risk, but there's potential for greater profits. The third thing that we take into consideration is convenience. There are no free lunches in this world. The price that you have to pay to outperform the market is putting in the time to do your research. There are a whole host of things that you need to take into consideration before buying stock, such as their future growth outlooks, their economic moat, and their current valuations. On the other hand, buying an index fund such as the S&P 500 removes a lot of this work that you need to do. Generally, the US stock markets always go up. Now, I don't have some crystal ball to tell the future, but this statement has held true for as long as the markets have been open. Going the robo-advisor route makes things even easier. For less than just 1% per annum, you let the team of experts and the AI do the research for you. The fourth and last thing that we need to take into consideration when deciding between passive and active investing is the freedom of choice. Now, just imagine it this way. You need to buy some fruits and you go to the local market. You stumble upon the first stall that sells fruits. They sell things in a bundle. It comes with oranges, strawberries, apples, and bananas. Some of them you like, some of them you might not. But the thing is, this stall sells the entire thing in one package. Either you take it all or you take none. Personally, I don't like oranges too much. So being not very happy with this, I tell the owner, you know what, I'm going to the next stall. Once you find another fruit stall, the owner tells you that you can choose whatever fruits you want. Just take what you like and pay for what you get. I just choose what I want and I'll pay the vendor what I owe her. This whole metaphor explains perfectly the best thing about active investing. You get to choose which stocks go into your portfolio and which stocks gets kicked out. I still remember the first stock that I ever bought being Maybank. I bought it simply because I just loved the bank, I liked their online banking, and so I decided I'm going to be an investor. When you invest in an index fund such as the S&P 500, you have to buy all 500 shares that come with it. You don't get to choose which one you like and which one you don't. It comes in an entire bundle. Through active investing, the choice is completely yours. You could avoid some companies that may be big in size, but you think has no potential for future growth. Some investors also only like to invest in companies with good EGS scores, which is environmental, governance, and social responsibility. Having taken the 4 considerations into account, we have a mix of passive and active investments in our portfolios. Most of my passive investments come from Stashaway. The money that I deposit is taken to invest in a whole bunch of index funds and resultantly a whole bunch of companies. Through this investing style, we're in it for the long run. We expect to get returns of 7 to 10%, which is in line with the average market returns over the last 100 years. Oof. It piques our interest to find out about the 100 different things that Amazon is doing or how Apple's latest smartphone release is performing in the market. By choosing many different individual stocks and putting it in our portfolio, it feels like we're building our own index funds. I'll be using a mixture of short, medium, and long-term investments in hopes of achieving this. Seeing the stock that you picked finally fulfilling its potential in terms of price is really a great feeling. It's also much more fun to tell your friends that you invested in Facebook because you really like using Instagram and you believe in your management team. I mean, if you tell your friends you invested in the S&P 500, do they even know what that is? Bottom line, if you're new to investing and don't really follow the global markets, go the passive investment route. Buy index funds, use Stashaway. It's hassle-free and low effort, so you don't have to put so much time into managing your investment portfolios. Still, we always encourage our readers and viewers to start investing. Over the long run, you can expect to get good returns with almost zero risk of losing your entire portfolio. For those of you who have some experience in investing and are keen to learn about markets, maybe you can try out active investing. In your portfolio, you should try to buy different stocks from different industries to help you with the lack of diversification that comes with active investing. That's it for this video. If you enjoyed it, give us a thumbs up, subscribe to our channel, and follow us on Instagram. Do it! Are you an active or passive investor? Let me know in the comments down below. My name is Emir, and thanks for watching. Peace out! Oof, I'm saying I think it's a mate, she downstairs.